Have you ever thought about running out of money in retirement? Well, if so, then you have to listen to today's show as we'll be covering some of the most common myths when it comes to retirement. 7 of them, to be exact. This is going to be fun, so clear your schedule for the next hour and find out what these 7 myths are all about. Good morning. I'm David Hollander, your host, and this is Protect Your Assets. For those of you just joining us for the first time, you hear the jingle. People around here call me the Sandman, and that's because I answer your questions, help you sleep better at night, let you know about what's coming your direction. And that's because I run a tax, legal, and financial firm. If you have a question, give us a call, 808-5627. You know the number, 808-KNBR. We are different than most firms because we get to know you and we like to figure out how we can help you. So call us, 808-5627. Today, we are doing something fun and a little bold. We are dispelling myths, 7 of them. These are some of the most common retirement misconceptions, and they come straight from research by the Boston College Center for Retirement Research. And here is what makes this so important. Most of these myths share one thing in common, and that's fear. Fear of running out of money, fear of losing benefits, fear of making the wrong move. And fear left unchecked can lead to some very, very expensive decisions. That surprises people. They think the big danger is being reckless, but often the bigger danger is being too cautious. In fact, the research points out that these fears nudge people toward overly cautious choices. Some retirees live well below their means. They deny themselves the trips, the experiences, the lifestyle that you actually want to live and that you work so hard for. All because of a myth you never questioned. So today we're going to question them. We are going to take 7 common beliefs and ask a simple question. Is this actually true? It's kind of like the they say of the whole show. So stick with me for the entire show as we're going to walk through them and answer them. Now let's get started. AI continues to dominate the market with the SK Hynix IPO, reinforcing enthusiasm around IPOs and AI. S&P was up this week 1.2%. Can't believe we're at 75.75 on that index. Whew, I'll talk about that in a minute. Year to date, we're up 10.7%. Dow off a little bit because remember, they don't have the same exposure as the S&P does to AI. Year to date, still up 9.5% though. NASDAQ, of course, big winner this past week, up 1.7%. Year to date, up 13.1%. And the big one still is the Russell 2000, off slightly, but still year to date, up 20%. MSCI, this is the international index. EFI index was off 1.4, year-to-date up 10.2. And the 10-year Treasury closed above the 450, 4.56 is the rate currently, and WTI crude oil, even with the renewed scuffle, if you want to call it, closed at $71.41 a barrel, up 4%. So, renewed fighting last week between the U.S. and Iran saw the price of oil rise, but nowhere near what we saw in March. Why? Well, I think neither the U.S. nor Iran appear inclined toward really a prolonged conflict. And since the ceasefire in June, oil supplies, well, they've began to recover. And now they provide a buffer for energy markets. And you add to that, the labor market remains strong. U.S. corporate earnings look real good. And rates overall, well, they're pretty stable. So what's going on with AI? Well, of course, we were talking about the SK Hynix IPO. This is the infrastructure AI IPO that just came out. And anything related to AI has become a little bit more volatile on the down and the up as investors question the pace and the payoff of spending. So we're seeing signs right now of some fatigue with end user demand for AI becoming more price sensitive and the market starting to penalize companies that ramp spending too aggressively. So one of the things we look at is this, call it the MMT, the market multiple level. I've talked about this in the past on the S&P. So where are the caps, bottoms, midpoints? Right now we're seeing 73.10 as a support level. The better if market scenarios, things get better, calm down overall. And so the support level right now is at 57.35. 57.35 on support. What does that mean when you're thinking about the market right now? Well, for the second half of the year, because now we are in the third quarter, we're going to start to see earnings reports coming out. It's going to start next week with the banks, and then we're going to see the large AI support companies and tech companies start to report as well. What are we watching next week? Well, inflation, of course. Tuesday, we're going to get the June inflation reports, the CPI for June. Then Wednesday, we'll see PPI, which is production inflation. And then Thursday, retail sales. And then earnings seasons, and the banks like Chase and B of A are going to start reporting. So all that's going to be what we're watching next week. And it is time, once again, for our monthly Bitcoin and crypto update. So what's going on in the industry? Well, you got Schwab. They're preparing to roll out more crypto services, spot trading, transfer, and custody for financial advisors in 2027. It's big news. Japan's National Business Corporate Pension Fund plans to invest about 1% of their 21 billion yen assets in crypto. Coinbase announced product expansion. Kraken, I love this one. Kraken is launching perps trading in the U.S. I read about that. You might want to chat GBT that and just say, what's a perp? NASDAQ said it will distribute its total view market data feed, and this is going to become the first traditional exchange to push depth of book equity data onto an on-chain Oracle network. Some more big news. Noteworthy ETF. These are the ETFs that are being created to deal with crypto. There are some new launches. iShare Bitcoin Premium Income ETF is starting. Franklin Templeton, this is a local Bay Area firm out of San Mateo. They filed for 2 stock ETFs, which will reinvest dividends, get this, in Bitcoin. XRP and HYPE, those are 2 ETFs. They stood out in June with inflows of capital of $59 million and $161 million, respectively. And the UK's FCA proposed allowing certain authorized retail investment funds to hold up to 10% of assets in crypto ETNs. What's going on in the stable coin progress? Well, companies that made moves in stablecoin ecosystem, meaning they'll start to accept them. Visa, MasterCard, Fidelity, Bank of New York Mellon, Nomura, SBI, SoFi, Stripe, MetaMask, Ripple, Chainlink, World, Liberty Financial, Zodia, Opera, Fireblocks, Plasma One, Squid, Toss Bank, and Hyper Foundation. So a lot of more companies getting into that. And then some regulatory moves for the month. The SEC published its draft strategic plan for fiscal years 26 through 30, placing digital assets at the center of a broad regulatory reset. Treasury Secretary Scott Bessent said the administration is proceeding with all deliberate speed, that was a quote, in creating the Trump-ordered strategic Bitcoin reserve, and urged senators to pass the Clarity Act this summer. And the Fed proposed a new limited-purpose payment account, allowing fintech crypto firms to clear and settle transactions directly through the Fed without a full master account. So all these are, again, more support that is continuing to strengthen that area of the market. Making the right decision when it comes to your Social Security, is that important? Well, if you want to know what to do, stay with me. You're listening to Protect Your Assets. I am David Hollander, the Sandman, and I'll be right back. Welcome back. I am David Hollander, also known as the Sandman, and you are listening this morning to Protect Your Assets. There are seven common misconceptions out there when it comes to retirement, and according to the Boston College Center for Retirement Research, any one of these could seriously affect your retirement. Find out what they are and if they are true or false or what you need to know about them. We're going to get right into that, but before we do, one of the best ways to save money in retirement is to think about how you pay your taxes. Now, many times you just don't even think about it. You just get income from different investments, from your real estate, and you just give that information to your tax person and you just go on your merry way. And as you know, they prepare your taxes. They don't really help you think about how to make more income or take more deductions unless they're really good, or give you any specific advice on how you might want to reinvest your money for that particular year to get a little more out of it. We're going to get into the 7 common misconceptions that the Boston College Center found that people in retirement think about and then don't act. They don't do it because they're afraid, the fear. And then it changes their life in a lot of ways that aren't good. So what's the first myth out there? Social Security won't be there. You ever think about that? This one is everywhere right now. The headlines say the trust fund runs out in 2032. It's not too far away. And people read that and assume their benefits are going to vanish. But that's not what the data says. Even under pessimistic projections, the program could still pay out roughly 80% of promised benefits. Why? Well, because payroll taxes keep coming in every year to feed the beast. So the worst case is closer to 22% in terms of a reduction, not a total wipeout. And Social Security has enormous political support. Don't forget, Congress has adjusted it before and almost certainly will have to do it again. Now, to be fair, changes may come. You might see somewhat lower benefits or higher taxes when Congress acts, and that could affect your plan. But it is not the doomsday many people fear, which is a complete wipeout. Here's the danger of the myth. If you panic and claim your benefit too early, you could lock in a permanently smaller benefit. And if you think about that, let's say that your benefit is $2,000 more per month than your spouse's at your full retirement age. You believe Social Security will not be here in 10 years, so you take it now, before your full retirement age. You tragically die in the next 5 years, and now your spouse is stuck with your lower benefit instead of the higher benefit he would have had you waited till your full retirement age, or 70. So when it comes to Social Security, precision beats panic. Don't forget that. Let's take a look at myth number 2. I don't need a long-term care plan because I'm going to stay at home. Well, that is a comforting belief, and I'll just stay home. But the research is sobering. About 80% of retirees will need some form of long-term care. Think about that, 80%. And staying home is not free. Home health aides cost at the median level right now about $75,000 a year. On top of that, fewer than 5% of people over 50 have private long-term care insurance. Less than 5%. So that means that you most likely are going to have to pay for any type of care, long-term care, out of your pocket. Add to that, if you cannot stay home, what would that look like? Not just the cost, but how you take care of that. So here's the key from the research. Don't confuse a preference with a plan. If you want to stay in your home, that's a wish, and that wish may or may not come true. Funding the care to make it possible is part of the plan, but it's not the full plan. You should make a full plan that not only involves the money part of it, but also the practical aspect of what's going to happen, particularly if there's some sort of a dementia or Alzheimer's, where you need more support that the home cannot provide, most likely. If you don't have a plan, many households are forced to drain their savings and potentially fall back on Medi-Cal. And that's a tough spot for anyone who works hard to build wealth. So do you know how to maximize your Social Security benefits? How do you help your kids help you later if you're the one who ends up needing long-term care? If you're thinking about retirement, I have a complimentary retirement checklist that we've put together that I'm giving away right now this morning to all my listeners. And you can get it right now absolutely free by doing this. 866-PROTECT, 866-776-8328. Get yours right now. Coming up next, it's time for our popular They Say segment, where they say once you retire, you don't need a long-term investment strategy. How might that impact you? Well, probably not in ways you might think. You're listening to Protect Your Assets with the Sandman. I'll be right back. Welcome back. I am David Hollander, also known as the Sandman, and you're listening to Protect Your Assets this morning. If you're just joining us right now, today we're talking about 7 myths as they relate to retirement. This study just came out by the Boston College, and what it shows commonly throughout is fear is causing you to make some pretty bad decisions when it comes to retirement that really do affect your life. So we're going through these myths today. What are they? What do you need to know about them? Are they true? And what can you do about them? All right, so we were talking about the 7 myths as they relate to retirement. What myth number 1 had to do with your Social Security. Myth number 2 had to do with long-term care. And myth number 3, well, now it's time for our fan favorite. They say. So here we go. It's our They Say segment where we debunk common myths, half-truths, sometimes just bad advice that they say. So here's one that they say. In fact, I heard it this week, and this is myth number 3. They say retirees don't need to have a long-term investment horizon. This comes up all the time, right? You describe stocks as long-term. Retired clients often say, I don't need long-term because I'm not going to be here that much longer, and I want to de-risk my portfolio. Some of that's true, but sometimes it's not 100% true. Think about it. If you retire at 65, your planning horizon could be 25 to 30 years. That's a long time. Even though it doesn't seem like it, I know. 10 years go by, it's just like, $1 you will not spend until age 85 has 2 full decades ahead of it. And here's the choice. You leave it in cash or in very low risk things, that dollar can slowly lose value to inflation. And if you haven't thought about taxes and how you position all that, well, you're going to lose it to taxes too. So abandoning stocks entirely in favor of cash or low yielding bonds may feel safe, but it introduces a very real risk, and that's you outliving your money. As you get closer to retirement, you probably have what's called a target date fund. And those funds could place more of your investments into cash, into lower risk investments as you get close to that retirement date. Many target date funds do it automatically. While this can be a prudent strategy for some, it can be a terrible mistake for others. It's true that as you're near your retirement, you have less time to make up for potential losses, but that myth can get you into big trouble, particularly if you live longer than you thought. What's myth number 4? Medicaid will cover my long-term care costs. A lot of people believe they can protect their assets and still have Medi-Cal, or Medicaid as some people call it, pay for expensive care. But the reality is harder than that. Medicaid does not cover long-term care, but generally only if you have a low income and your assets are nearly gone can you qualify for it. In several states, the applicant can have no more than $2,000 in assets. People sometimes try to get around that by giving assets to their family or placing them in an irrevocable trust, but hear this. That can leave you in a precarious financial position. And not all nursing homes accept Medicaid, which limits your options. So this is why the general advice is this: don't give away all your money just to qualify for Medicaid. For most successful families, that's not a plan. It's a gamble. So myths 3 and 4 go together. Do not assume Medicaid is your safety net, and do not assume your investing days are over the moment you retire. If you're not sure whether your portfolio is positioned for a 25 or 30-year retirement, well then, let us help you review it. You can call us right now and get some help, get a second opinion. Don't forget, we do have estate planning attorneys here in the office. We have financial planners and tax professionals who all work together to get to know you and to help you create a better plan. We'd love to get to know you today and see you in one of our offices, or we can do it on the Zoom. It's that easy. How do you make that happen? You pick up the phone right now and you call us, 866-PROTECT. In fact, today we're giving out this quick retirement checklist I've put together. This is an easy read. It could highlight a couple things that you thought that aren't true. 866-PROTECT. It's time for a quick break, but when we come back, we're going to finish up these myths and see what's true. Should you spend your principal? It's a good question. The answer is coming up next on Protect Your Assets. We'll be right back. Welcome back. I am David Hollander, also known as the Sandman, and you're listening to Protect Your Assets this morning. A lot going on in the world right now, right? We just had sort of a rekindling last week of the war that battles on, and oil didn't really react too much, did it? Went up a little bit, but not like we saw in March. Today we're talking about the 7 myths of retirement and what you need to know about them. This study just came out of the Boston College, where they were looking at 7 different things that affect decisions you make in retirement. And the common theme throughout them all was fear. And myth number 1 had to do with Social Security and how you take that based on, again, maybe inaccurate information. Myth number 2 had to do with long-term care and what you need to be thinking about as it relates to long-term care. Myth number 3, well, said you don't need long-term returns anymore. Myth number 4 said Medi-Cal will pay for long-term care. And so now we're on to 5, 6, and 7. So now let's get on to myth number 5. This one I find quite a bit. And it's this. It's I shouldn't spend from principal. And what this one does is it steals joy from retirees. How? Well, you're committed to just spending only the interest or dividends that your portfolio generates, and you never touch the principal. Let's think about that. Maybe you own a stock and they recently declared a small dividend, and because you own a lot of that stock, because maybe you bought it at a low price or you work for the company and they gave you a bunch of it, and so the dividend, after all that's said and done, is not bad. It keeps you living the life that you've been living so far, and so you just go ahead and spend that. But you got a lot of money sitting there in that stock, and so you don't sell it just because, again, for all the emotional reasons of working there and how it's done for you and all that. Believe me, I've heard every line you could think about. Is that smart? You're doubting it right now, aren't you? Of course you are, because it's not potentially smart. Why? Well, there's things called estate taxes. And if you have more than the estate tax in that stock and it grows to more than that, well, guess what? You're going to lose a big chunk of that to estate taxes and you're never going to get the benefit of it, and neither is your family. So what are you doing? Secondly, long-term capital gain rates are not that bad right now. They've been a lot worse. Go back and look in the 80s. Take advantage of that. What's wrong with that? Well, here's why. Because you don't know what you're going to do